Well, welcome. From time to time, we want to get various members of our team together and have a little chat. So today I have with me some members of our investment committee. I have DJ Hunt, Ron Tamayo, and Ryan Osborne. All of us are certified financial planner professionals. And today we're going to talk a little bit about the investment committee, so investment issues, and we'll see where this conversation goes. So lately, we've been hearing a lot in the media and from clients about a couple things: inflation and the SpaceX IPO, initial public offering. So to kick us off, Ron, why don't you tell us what we need to know about inflation?
Sure. Inflation, what I call the silent killer of purchasing power. It's something that we model in all of our investment plans, all of our retirement models. We have historically modeled anywhere from 0 to 6% annual inflation. We've been doing that for 25 plus years. Inflation's become a much more prominent thing now in our conversations with clients as a result of COVID. We've seen the spikes in prices coming out of COVID. Now we've seen spikes in prices due to oil prices going higher due to the war. And it's become, a topic of conversation, both politically on the news, client conversations, socially, and so forth. The interesting part about inflation is that there is really no magic bullet investment or product that is, kind of able to keep pace with inflation, manage tax consequences, and reduce or avoid volatility. There have been things that have come out, different investment products that people have talked about would solve the inflation problem. For example, cryptocurrencies or Bitcoin was commonly referred to as something that would keep pace with, with purchasing power.
Yep.
Certainly is something that has run up in price significantly, but the volatility around that kind of an asset is extreme, would cause extreme tax consequences. So it's not necessarily something that we look at as part of a portfolio that's going to solve the inflation issue. For us, the best solution has historically been and continues to be a globally diversified portfolio, mostly consisting of equities. Equities have historically outperformed inflation probably by about 7 or 8%. When we go back all the way to 1926, we look at historical rates of return of equities, large company stocks, small company stocks. They've yielded annual rates of return of anywhere from 10 to 12%. Inflation has historically, since that time, averaged about 3%, recently higher. But that was coming out of a period where we were actually averaging below 3% inflation for a period of time.
Right.
Again, we've modeled consistently when we run our Monte Carlo simulation and retirement models, inflation rates of anywhere from 0 to 6%. We don't model deflation. Deflation is actually worse. That's, when you're entering a depression. So we don't want to see that again, for sure. But we have historically modeled inflation rates that could be upwards of 6%. We did see, I guess, the high probably a few years ago coming out of COVID in 21, 22 was probably around 9%.
Yeah, that was bad.
That was very bad. I think the biggest issue around inflation, of course, is the lasting effect. Most of the general public believes that, when we see high inflation rates, that they're going to come back down. Well, inflation is only telling you what's the rate of the change of increase in prices. It doesn't tell you if inflation comes down from 9% to 3%. Doesn't mean that you're going to see a 6% drop in your prices. It's just that you're seeing less of an increase in your prices. So it's that continual effect that we see, that reset in prices higher, that has a lasting effect that really affects the psychology for a great number of years for most people. We're still feeling the effects of that 9% inflation now, 2-3 years since?
I mean, I can't think of anything where prices have come down to what they were pre-COVID.
Exactly.
Right.
We've seen housing prices, much higher. We've seen energy prices higher. You know, from time to time, we see some reductions. Healthcare costs, groceries, of course, the things that we tend to buy and deal with most often in our daily lives are the things that we have seen probably the greatest impact on. And so, again, no magic bullet to fixing it other than having that globally diversified portfolio, making sure the assets that you have set aside for long-term retirement, that nest egg, is invested in such a way that historically has provided a premium rate of return above inflation, and that when you take into consideration taxes and inflation, you're netting a positive. That simply cannot be done by just investing your money in a 90-day treasury bill. You will certainly be negative. That can't happen simply by investing in longer term bonds. Your rate of return will still be negative after inflation and after taxes. And outside of those two solutions, you're looking at other investments that are going to be very volatile. And now you've got, you have to have the stomach to endure that kind of volatility, which is not what we like to do, see in the portfolio, right? So global diversification, stocks, bonds, large, small, globally diversified, not only in the U.S., but also in foreign countries as well. That continues to be the best solution.
Yeah, we've seen it for a long time, and that's been the case, right? If you want to try to hedge against inflation in the short term, very few things do that very well consistently. Well, nothing does it consistently, right? Exact in spots. That one worked that time, this one worked that time. So it's a new era, special time over on the Space Coast for us. We get to watch rocket launches out our windows of the office and from the backyard. SpaceX has had its initial public offering IPO. DJ, tell us about SpaceX.
Well, it goes without saying that a lot of folks local to the east coast of Florida are talking about SpaceX because we have a hometown connection. They're a big employer in our area. We have clients that work there. And so it kind of has a different than other IPOs, for example. This has a sort of a connection that people actually are more tangible. So we did hear from several clients about, hey, how do I get into this? Everyone who knows us and has been around us for a while knows that our investment philosophy excludes making bets like, investing in IPOs and whatnot. And this IPO has performed like a lot of IPOs in that the folks who got in on the IPO price, they're still above water, but everybody who bought on the first day has actually lost money.
Yeah. How does that?
As of the
That's right now, anyway.
As of right now, so yeah. So
Looked pretty good for about a week, but
right. A couple of days.
That's right. Yeah, just a few days, but it's the rocket has come back down to the landing pad. So it's something that it's exciting. Elon's the first trillionaire in the history of the world.
Yeah.
He's made a lot of local folks very wealthy. Folks that otherwise would not be where they are. So it's a lot of good stuff. But generally speaking, our investment philosophy eschews buying single stocks because we don't know the history of any, or we don't know the future of any one stock.
Right.
But we can take a fairly good grasp at the history of the entire market.
Yeah.
So as exciting as the SpaceX IPO is and was, we continue to preach a broadly diversified portfolio that invests in a little bit of everything. And that gives you a fighting chance of having something going up in your portfolio no matter what's going on.
That's right. That's right. Yep. That's the old joke. IPO, it's probably overpriced.
Right.
It's supposed to buy low, sell high. And as it's been the case with a lot of very hyped, highly followed, or whatever you want to call it. A lot of those IPOs have that initial pop right off the bat. If you run to get in there on the first few days, very often it does not work out very well. You've got to have a really long time frame.
That's right.
Yeah, buy low, sell high. This is probably not a buy low moment, but we don't know, right? This could be the lowest it ever is. It could take off like a Falcon 9 for all.
It's this SpaceX and a lot of Elon's companies do not follow the traditional, technical or a fundamental analysis as it relates to stock selection, because they lose billions of dollars every quarter.
Right.
And you know, they've got a super rich valuation that you know, there's smart people on both sides of that argument. There's smart people that say this is the they're calling a top right here,
Yeah.
you know, and then they got other people saying, you know, smart people saying that all the different reasons that it has a reason to run. Nobody knows who's right. That's what makes a market.
That's right. Can't buy unless someone will sell. You can't sell unless someone's willing to buy.
That's right. So, you know, soon enough, it'll be in all the index funds anyway.
That's right.
And so,
Anecdotally, it was probably, I mean, from our clients, it was one of the most interesting, most talked about IPOs that I could think of in my 30-year career.
Right.
Yeah.
Yeah, I think so too. I think so too. Sure. Yeah. All right. Let's change gears here. And besides talking about hot topics, Ryan, why don't you tell us a little bit about what an investment committee does?
Yeah, so our investment committee, we are in charge of helping the firm create the ideal client portfolio. That all starts out with developing a sound investment philosophy and then building around that and reviewing that periodically. So we'll start out, kind of talk about things with the investment committee and roll that out to advisors, the tax team, and we'll all get on the same page, work together to create that ideal asset allocation. And, it takes that communication to come up with the ideal asset approach because no asset on its own is risk-free. So we have to come together, decide what makes the most sense, and build that portfolio, put some thought into that. From there, we go into the actual investments that make up those asset allocations. And that's a little bit different per client, per portfolio. We want the best investments that we can find for each asset class. And we monitor those over time. As markets move, that starts to drift. We'll monitor that, make changes as needed. In a taxable account, that might look a little bit different than a qualified account.
Right.
And so we'll weigh the implications of what does it look like to make that change now? Do we want to pay those taxes now versus kind of wait on that? So our goal is for every account to have, every account and every investment to have a purpose, right? We don't want to make changes just based on what we think is going to happen or anecdotes or speculation, what you think is going to happen in the future. We want all of the decisions that we make as an investment committee to have that purpose and have that research and evidence-based approach.
Right. Excellent. So Ron, tell us a little bit about what the committee's been doing lately.
Great question. And we have been pretty busy lately. We've done a deep dive on looking at our investment policy statement. The investment policy statement is where, with every client relationship, we're laying out pretty much a letter of understanding of the parameters around which we're going to manage that portfolio for a client. Those parameters and that asset allocation is based upon the results of their longer term modeling work, the cash flow modeling work that we do, a retirement model. Client comes to us, they tell us their goals and objectives. We develop a plan. Out of that plan, it tells us essentially what their target rate of return is. It's going to be a range. It's never just one number, right? It would be nice if it was just one number, but it's typically a range. And that gives us very good information as to what's going to be the appropriate asset allocation. Now we need to juxtapose that with their risk tolerance and their risk capacity. Once we've done that work and we have the asset allocation, we put forth a investment policy statement, which lays out how much we're going to expose the portfolio to cash, stocks, bonds, and in the past, how much was going to be allocated to real estate. One of the things that we've been doing here recently is looking at that last category of real estate. And, we've done some soul searching. The committee has had long discussions. We continue to have discussions around that particular asset class. In that particular asset class, we've kind of arrived at the conclusion that a better title for it, a better name for it, is an alternative asset class. There are a lot of investments out in the world today that can be covered under the umbrella of alternatives. For example, private equity, which has exploded in popularity and in size, private credit, hedge funds, real estate. So as I'd say would be the four main categories. And you could have liquid alternatives as well. Give you an example of just how much the landscape has changed. The U.S. equity market, public equity market, is about 70 trillion in size, that they believe at the end of 2025. Today, the private SEC listed private funds are about 27 trillion. Wow. That's a pretty significant size. From the investment committee's point of view, that's a very, very large market that investors may not be exposed to. Sure. And so we're now evaluating, how we can get exposure to those assets in a very cost-efficient, tax-efficient way. So we're looking very seriously at other alternatives and seeing how we could do that in a very diversified manner. Again, we don't like to, much like SpaceX, right? We're not going to throw all of our eggs in one basket. That's not what we want to do for clients. There's too much individual, stock or individual investment risk. No need to do that. So we're looking at ways where perhaps we can add some diversified exposure that would now fall under the umbrella of alternatives. So that's one of the things that we've been looking at. We've also redesigned, kind of simplified the layout of the investment policy statement, made it a little bit more clear and concise. Not that it wasn't before, but I think it was due for a change. I think it's probably been, I think, Dan, you were involved in the first iteration.
Charlie said,
at least 10
look at the format on it.
Yeah, so it's been a long time. So that's what the committee's been busy working on. We're excited about some of the changes. DJ and Brad were working on changing some of the verbiage and the language to make it, more understandable for clients, a little bit more user-friendly. And I think we've arrived at that end product. So we're excited about that and excited about, taking a look at the alternative space. Maybe we're a little bit late to that party, but that's okay. We'd rather be late and being very, performing our due diligence. And in some ways, we actually will take on some of these investments ourselves as individuals just to see how it goes. And before we, roll it out for clients at times, before we take that big leap. But those are pretty much the two main things that we've been dealing with pretty recently.
Yeah, you guys never run out of things to do. There's always new stuff coming to market. And over the years, we've changed a lot of things that we put into client portfolios because a better alternative arrived. Right. Not every new thing is good. Some of them are just shiny objects that get your attention, and due diligence is a very important factor for any investment today.
As I was telling our new analysts today and our couple of interns that we have, that we are product agnostic.
Right.
If we can find a product, a fund that fits our investment philosophy for that particular asset class, and they can do the same job at a lower cost, by all means, we're going to be open to that.
Yeah, I mean,
and we're going to be allocated as part of our investment returns process as far as the select funds.
It's the advantage of being truly, totally independent. Right, work for clients, not for any of these product manufacturers. So minimizing to stay on their own merit. Right? Yeah.
Minimizing costs is the one thing that we can control in the portfolio. But taxes and costs.
Yep.
Everything else.
Yep. And taxes is a big cost, so it's worth managing for sure. All right. So DJ, what's you're planning to look at or do next?
So one of the things that we are constantly doing is evaluating the current holdings that we have in our portfolio. So that's sort of an ongoing project or process that we look at each one of the funds that we have employed in each of the asset classes, and we compare them to their peers and to their benchmarks to make sure that we've got the best one that we can find. With always with an eye toward good performance and low fees, high speed, low drag, as the saying goes. So, we want to make sure that each one of the funds that we have is the best one we can find. And to Ron's point, we don't care what it's called or the producer of that fund, the sponsor of that fund. We don't care. We just we have the ability to buy anything. Yeah. And so we're constantly evaluating the portfolio, making sure that what we have is the best that we can find. And we don't make changes very often, but sometimes we will have a manager that for whatever reason is just not keeping pace, and we have the ability to get rid of them and bring in a product or a fund that's doing the job correct. And from time to time we do that, but the only way that we can know when it's time to do that is to constantly evaluate.
Yep. Very good. All right. Well, before we wrap up, I want to congratulate Ryan here for becoming a CFA charter holder.
It's a big accomplishment.
It is. It is. It is. It's probably, no, I know it is the most prestigious designation that people in the investment management world could get. Your portfolio managers of mutual funds, endowments, sovereign funds, all kind of institutional level investment managers seek the CFA. It's a global, almost 300,000 of them around the world, and it has a reputation of being a gorilla to conquer. What made you pursue that?
Being part of the investment committee, I just thought it was a good opportunity for me to learn a lot more about investments and financial markets in general and contribute to the committee. And so, of course, Moisand Fitzgerald helped me out along the way and supported that. So I thought it was too good of opportunity to pass up.
Well, we're glad you did it. I've looked at it a number of times over my career, and I always balk because it's just way too much time. I mean, I like to think I would pass all the exams. I'm pretty confident I would, but it would require a lot of study. I went to the CFA website, got some statistics about that, by the way. The general average pass rate for level 1 is just 41%. Level 2, it's 45%, and for level 3, it's a coin flip. So
Sounds about right.
you accomplished something. Pretty impressive. Congratulations. We're all very happy for you.
Thank you, Dan. Sure.
I think he's a glutton for punishment, personally.
There might be some truth to that as well.
Yeah. I mean, he's into rock climbing. Is that correct? So rock climbing, a CFA. I mean, yeah, the difficulty level is about the same.
Yeah.
Yeah.
Some correlation there.
Well, again, congratulations. That's fantastic. Yeah, with all the shiny new objects out there, we're still 100% committed to the idea that diversification, patience, and discipline is the best way to go, rather than chasing shiny objects and speculating with our life savings. Financial planning is the context within which we manage all of our portfolios. Investment management is by far better off done in that context. Make it matter and customized to each family and what's important to them. So we thank you for joining us. I want to thank our guests for being with us today. And if you have questions about anything we talked about or anything at all, contact your advisor. We'd love to hear from you. Have a great day.